So, you have been hearing a lot about the Pi network. Maybe you have been mining on your phone. Now, a big development has just happened. The Pi DEX has officially gone live on the MAINNET. This is a significant moment for everyone in the Pi ecosystem. It marks the transition from a long period of development and testing into a live, functional environment where real value can be exchanged. For users who have been accumulating Pi, this is the moment it gains real utility. It moves beyond a simple balance in an app to something actively used in a decentralized marketplace. Why does this matter? It's about creating a user-driven economy. Before this, Pi lived inside a closed system. Now there is a live decentralized exchange for peer-to-peer trading. The launch introduces liquidity, crucial for a healthy market. Users can trade and also contribute assets to support the market, potentially earning rewards. This builds a robust financial ecosystem around Pi. Moving to MAINNET changes the user experience. What was theoretical is now practical. The Pi in your wallet is no longer just a number on a test server. It represents real assets on a live blockchain you control and transact with. This brings opportunities and new responsibilities. It opens the door for price discovery, where trading activity starts setting a market value for Pi. It also means transactions are final and recorded on an immutable ledger, so learn the process and act with caution. Let's break down what a DEX actually is, using simple terms. A DEX is a decentralized exchange. Think of it as a digital marketplace for trading cryptocurrencies, but one that isn't owned or operated by a single company. Instead of having a central authority that holds everyone's funds and matches buyers and sellers, a DEX runs on a blockchain. It operates through a set of automated rules written into code, known as smart contracts. The key difference between a DEX and a traditional centralized exchange lies in who controls your funds. On a centralized exchange, you deposit your tokens into an account owned by the company. They hold your assets for you, and you are essentially trading IOUs within their internal system. On a DEX, you always maintain control of your own funds in your personal crypto wallet. You connect your wallet to the DEX, but the assets never leave your possession until a trade is executed. This is often referred to as non-custodial trading, and it's a core principle of decentralized finance, or DeFi. You simply connect your wallet and start trading. It's a system built on code and community rather than corporate control. You will often hear the terms testnet and mainnet when discussing blockchain projects, and understanding the difference is crucial. Think of a testnet as a practice field or a simulator. It is a complete replica of the blockchain network, but it operates with fake money or tokens that have no real-world value. Developers use the testnet to build, to experiment, to find bugs without risking any actual funds. For users, a testnet is a safe sandbox where you can learn how to make transactions, connect your wallet, interact with features without any financial consequences if you make a mistake. The mainnet, on the other hand, is the real deal. It is the live public blockchain where transactions are recorded permanently and involve tokens with real economic value. When a project like the Pi DEX goes to mainnet, it means it has graduated from the testing phase and is now deployed on the live network. Every transaction on mainnet is final, irreversible, and costs real network fees. This is where the stakes are real. It's the equivalent of a store opening its doors to the public after months of preparation. This transition is a major milestone, signaling the platform is ready for its intended purpose. Move slowly. Double-check everything. Only interact with official, trusted applications. The mainnet is where the training wheels come off, and you are in full control of your real assets. Liquidity is a term you will encounter constantly. It's arguably the most important factor for a healthy market. In the simplest terms, liquidity refers to the ease with which an asset can be bought or sold without causing a significant change in its price. Imagine a small village market with only one apple for sale. If someone desperately wants it, they may pay a very high price. If selling, they might accept very low. That's an illiquid market. A supermarket with thousands of apples is a liquid market. Marketing graphic: low liquidity, shallow pool with big splash. Marketing graphic: high liquidity, deep pool with tiny ripple. On a DEX, high liquidity lets traders execute large swaps without dramatically affecting price. If you try to swap $1,000 worth of token A for token B in a low liquidity pool, the price might shift so much during your trade that you only end up receiving $900 worth of token B. High liquidity minimizes this slippage, making trading more efficient and predictable. Without sufficient liquidity, a DEX is practically unusable. It creates a chicken and egg problem. Traders seek high liquidity. Liquidity comes when users are confident. So when you hear that the Pi DEX is live, watch how much liquidity it attracts. A higher TVL generally means deeper liquidity, lower slippage, and a better experience, and supports PI's price stability and utility. So where does all this liquidity come from? It doesn't just appear out of nowhere. It comes from users who choose to become liquidity providers, or LPs. A liquidity pool is essentially a big pot of digital tokens locked in a smart contract. Typically, a pool consists of a pair of two different tokens, PI and a stablecoin like USDT. To create the market, users deposit an equal value of both tokens. These pools are governed by an automated market maker, or AMM. The most common use is X times Y equals K. X represents PI in the pool, Y represents USDT, and K is a constant. When a trader adds USDT and removes PI, the AMM adjusts price to keep K constant. As PI supply drops, its price rises, and vice versa. There is always a price, regardless of trade size. The incentive is earning trading fees, often around 0.3% per trade. Fees are shared among LPs based on their contribution. When you deposit, you receive LP tokens, your receipt and claim on your share and earned fees. If you are considering participating more actively in the Pi DEX, you might be interested in adding liquidity yourself. The very first thing you will need is a compatible crypto wallet that can connect to the Pi mainnet. This must be one you control, meaning you hold the private keys, the seed phrase. Fund your wallet with the two tokens, for instance, PI and USDT. Next, navigate to the official Pi DEX website or application. Be extremely careful to use the correct official link to avoid phishing scams. On the platform, go to Pools or Liquidity, then choose Add Liquidity. Select your pair and enter the amount. The second token amount is calculated from the pool ratio. Before depositing, approve token access in your wallet. It is a good practice to approve only the specific amount you intend to deposit, rather than unlimited approval. After approval confirms on-chain, click Confirm Supply and sign the deposit transaction. Upon confirmation, your PI and USDT are deposited into the pool, and your wallet receives LP tokens, your claim to a share of the pool and the fees it generates. Track your position and fees in the DEX interface. When ready to exit, remove liquidity by swapping LP tokens back for your assets, plus accumulated fees. Take it step by step and be careful with the links and approvals. While providing liquidity can be a great way to earn passive income, it's absolutely essential to understand the risks involved. The most unique is impermanent loss. It's the opportunity cost when token prices change versus simply holding. If PI skyrockets while USDT stays flat, the AMM rebalances, leaving you with more USDT and less PI than you started. If you withdraw then, your total value may be lower than just holding. The loss is impermanent until you withdraw. If prices revert, it can disappear. In volatile markets, impermanent loss can outweigh fees. It's the core risk for LPs. Smart contract risk. The DEX runs on code. A bug, exploit, or vulnerability could drain a pool, causing total loss. Look for professional audits by reputable firms. Platform risks and scams. Fake websites trick users into signing malicious transactions. Bookmark official URLs and avoid unsolicited links. Projects can fail and tokens can lose all value. DeFi is innovative but risky. Never invest more than you are willing to lose. Yeah, so stay alert and only risk what you can afford. Protect your private keys and seed phrase at all costs. Never share it. Never store it online. A legitimate DEX or wallet will never ask for it. Write it down and store offline in multiple secure locations. Use only official links from Pi announcements, blog, or social channels, then bookmark and use that bookmark. Start small. Practice approvals, deposits, fees, and withdrawals with amounts you can afford to lose. Prefer exact amount approvals, not unlimited. Regularly review and revoke old permissions with a block explorer. So yeah, be cautious and take these steps seriously. The launch of the Pi DEX on MAINNET is pivotal. It transforms Pi from something you only accumulate into an asset you can use in a decentralized marketplace. A DEX is user-controlled, peer-to-peer, running on smart contracts. Liquidity is the fuel. Add tokens to pools to help create a stable trading environment and earn a share of fees. But there are risks, impermanent loss, vulnerabilities, scams. So prioritize security, caution, and education. Start with small amounts. Use official links. Protect your private keys. Never stop learning. Trade responsibly. Provide liquidity if it fits your plan, and help build a secure, vibrant Pi ecosystem.